President-elect Donald Trump threatening additional tariffs against countries that shun the dollar. The moves calling into question what his policies are going to mean for global markets and investors. Let's discuss with Chris Versace. He's Tematica's research chief investment officer. Chris, it's great to have you back here on Yahoo Finance. We certainly are seeing the ripple effects play out in the currency markets this morning. How are you assessing just what the potential impact is going to be?
So when it comes to Trump, I think we have to remember that, a lot of what he likes to do is to keep folks kind of off balance, if you will, throwing a lot of stuff out there. It is relatively early days. I think he's doing just that, whether or not it's with Mexico, Canada, or now, the BRICS. So I think we need to see how they respond. And so far, it appears that, Canada and Mexico are starting to respond to what Trump has kind of been putting out there. But we do have a long way to go, and there's going to be a lot more that we need to really piece together for the Trump agenda come January, whether it's going to be further tax cuts, tax cut extensions, tariffs, and much more. So I think we need to pay attention, but not take our eyes off the data, because we do have the Fed meeting later this month.
Well, it's interesting. I want to stick on tariffs before getting to the data with you, Chris. I wonder, this 100% tariff threat on the BRIC bloc, does that really come back to China? Is that about a threat to China more than it is about those BRIC nations specifically?
I think it's a little bit of both. Obviously, Trump wants to squeeze China where he can, both directly, indirectly. So I think you're right on that. But at the same time, he wants to make sure that other countries stick with the dollar. That's extremely important. He's been very vocal about that. So I see this more as kind of a comprehensive approach more than anything.
Chris, you mentioned the fact that we have the Fed meeting later on this month. Lots of questions just about what exactly Fed policy is going to look at. Not so much what we hear later this month, but looking ahead to 2025. What do you see as the likely pace of some of those rate cuts?
Well, I think some of that's going to depend on what we learn this week. We get the November PMI data from ISM, the November employment report, and that employment report is going to be, I think, a little more important than usual. Remember, the October report was fairly messy, but I think the other thing folks really want to understand is the updated set of economic projections that the Fed will be sharing when they deliver the next monetary policy decision. And so far, the Fed has underestimated the strength of the economy. They might have to bump up their GDP expectations. If we see that, then the number of rate cuts that they're forecasting might come down. Remember, last time they called for 4, but the market was already seeing only 3 rate cuts between now and the end of 2025. So I don't think the market will be nonplussed by that. If the Fed signals even fewer rate cuts, that would be something that would disrupt the market.
So what does clarity on that path forward look like from the Fed, Chris?
Well, I mean, there's a lot of data that we're going to get before we get to the January, February, March, time frame. So I think pretty much the mood that we've been in of having to watch the data week to week, month to month is going to continue. And, if we examine the landscape of what we've gotten, there's no question that inflation remains sticky, right? We saw that last week. We saw that with the October CPI, PPI data. So if we don't see that coming back down, that would be a little worrisome. And it would say that the Fed can stay higher for longer. The question is how much higher, because I do think the Fed, past a certain point, does want to get back to neutral policy. So they're really going to be data dependent. That's the message.
Chris, what's your top trader? I guess, where do you expect to see some of that leadership coming from then next year?
We've done a pretty good job of isolating companies that are growing their earnings faster than the S&P 500, that have pronounced tailwinds. That's really allowed the Street Pro portfolio to outperform the S&P 500 so far this year, and I think we're going to stick to that knitting. So we've capitalized on, AI, just like a lot of other folks, but we've also looked for other areas that are benefiting, whether it's going to be a pickup in housing as the Fed continues to cut rates, the powerful joint forces of lower interest rates and stimulus spending. That's been very good for infrastructure plays. So that's kind of the way that we're looking at it. We'll continue to modify as more data becomes available, and candidly, as we understand a lot more of what Trump is going to be doing with his policies come January.
Given that challenge moving forward, the lack of clarity from the incoming administration. What is your take on how investors should be viewing specifically what's going on in the yield space? We've been seeing yields coming off their highs, perhaps related to some of the downward surprises that we've seen in the economic data. How are you parsing the impact of treasuries on equities?
So, we've been following it, and if you look really over the last, 4 to 6 weeks, they've actually trended higher. That tells us that, along with the dollar, that perhaps the Fed may not be cutting as much near term as folks had been thinking. So we're trying to position ourselves to take advantage of that. It has us kind of shying away from higher dividend yielding companies, because those become more attractive to us as yields fall, not as yields move higher. At the same time, to the extent that yields stay higher for longer, it questions the renewal of the TINA trade. There is no alternative meeting the stock market. So we might see money stay on the sidelines. So that's kind of how we're navigating that.
All right, Chris Versace, thank you so much for joining us this morning. We appreciate it.
Thank you.